Recovering from consecutive losses is one of the most defining psychological turning points in a trader's journey. It is not the market that tests you the most during these phases. It is your internal dialogue, your beliefs about risk, and your ability to stay grounded in a probabilistic mindset. Consecutive losses often create the illusion that something is fundamentally wrong with your method or that the market has suddenly turned against you. But in reality, what derails most traders is not the losses, it's the emotional reaction to them. The real challenge lies in how you think after those losses, how quickly you abandon discipline, and how easily you let fear dictate your next move. When a trader enters a losing streak, confidence becomes fragile. Every setup looks suspicious, every signal feels risky, and hesitation replaces clarity. You begin to see the market not as a flow of opportunities, but as a threat. This psychological shift is subtle but dangerous. It pushes traders into reactive behavior. Either they overtrade to get it back or they freeze and avoid taking valid setups. Both reactions are symptoms of a mind disconnected from the principles of consistency. Returning to profit after consecutive losses requires a shift back to neutrality. You must detach your identity from the outcome of your last trades. Losses are not a reflection of your talent or intelligence. They are simply part of the market's distribution. A mindset aligned with probabilities doesn't dramatize individual outcomes. It understands that losses are just one side of the equation and that the next trade has no memory of the previous ones. Once you internalize this, pressure dissolves and you regain the mental freedom to execute without fear. The first step is to reconnect with your process. Your edge hasn't disappeared, your confidence in it has. Review your setups with curiosity, not judgment. Ask yourself whether the losses came from execution errors, market conditions, or simply the random distribution of outcomes. By doing this, you shift into analysis instead of emotional reaction. When you analyze, you regain control. When you react, you surrender it. Next, reduce risk temporarily, not because you are scared, but because it helps reset your psychology. A smaller position size allows your mind to recalibrate. It brings back the sense of ease needed to execute accurately. With lower pressure, your ability to follow rules strengthens, and as you begin to see normal results again, confidence grows organically rather than through forced aggression. Consistency is rebuilt through clarity. After a losing streak, clarity is often lost, clouded by fear and frustration. But clarity returns when you realign with your trading plan, reconnect with your edge, and treat each trade as a unique event. The market does not remember your losses. The only memory is the one you carry. Letting go of that memory is the key to regaining your flow. Returning to profit is not about forcing a comeback. It's about reclaiming the psychological state that allows your edge to express itself. When your mind becomes neutral again, free from fear, free from pressure, free from the need to be right, you naturally move back into alignment with the probabilities that produce consistent results. Detaching emotionally from a losing streak is one of the most difficult psychological tasks a trader will ever face, yet it is also the most crucial. When losses accumulate, they begin to interact with a trader's beliefs, expectations, and fears in ways that distort perception. A trader might tell themselves they are objective, but internally the emotional weight of those losses sits like a shadow over every decision. The market suddenly appears more dangerous than it really is. Setups that were once clear now feel uncertain, and the mind searches desperately for signs that the next trade will also end in failure. Emotional detachment is not about ignoring the losses or pretending they didn't happen. It is about preventing them from influencing your interpretation of new information. Until you reach that point of neutrality, every chart, every fluctuation, and every potential entry becomes filtered through a lens of fear, frustration, or self-doubt. What makes emotional detachment so challenging is that losses trigger a biological response. The human brain is wired to avoid pain, and financial loss represents pain in a very direct way. When consecutive losses occur, the brain interprets them as a threat to security. This triggers survival-based thinking, fight, flight, or freeze, and in trading, all three create destructive behaviors. Fight makes you revenge trade, pushing you to jump into the next SE, top recklessly in an attempt to erase the emotional discomfort. Flight pushes you away from valid opportunities, causing hesitation, delayed entries, or complete avoidance. Freeze leaves you stuck between wanting to act and fearing the consequences, often resulting in poorly timed decisions. When you detach emotionally, you strip these primitive impulses from your decision-making process. You begin to recognize that loss is not danger, it is merely information. Emotional detachment requires a shift in belief regarding what losses represent. Most traders interpret a losing streak as evidence of personal failure or incompetence. They internalize the outcomes in a way that damages their self-image. This is the root of the problem. As long as a trader makes their self-worth dependent on the outcome of a trade, they cannot detach. Losses will always feel personal, and personal emotions cannot help but contaminate perception. Detachment begins when you understand that trading is a probabilistic activity, not a personal judgment. A losing streak is not a verdict on your ability, but simply a cluster in the natural distribution of outcomes. When this belief becomes strong, the emotional urge attached to a loss evaporates. There is no shame, no fear, no frustration, only data. One of the most effective ways to cultivate this neutral mindset is to evaluate trades based on execution, not results. When you shift your focus from did I win to did I execute correctly, you detach your emotions from the outcome and attach them to the process instead. This transforms the experience of a losing streak. Instead of feeling defeated, you become curious. Instead of feeling anxious, you become analytical. You begin to ask, did I follow my rules and did the market conditions match my system? When your attention centers on the quality of execution, your emotional condition stops swinging with every loss or win. You begin to value the integrity of your process more than the temporary outcome of a single trade. The challenge is that losses often create cognitive distortions. After a losing streak, traders tend to overestimate the probability of continuing to lose. The brain begins to search for patterns where none exist, attempting to protect itself from further pain. This is why detachment is necessary. When you detach, you prevent your brain from projecting past outcome into the future. You remind yourself that the market has no memory. Each moment is new, each setup unique, each signal independent. Emotional detachment is the mental state where you genuinely accept this reality, not intellectually but internally. When you do, the fear of placing the next trade dissolves because you no longer associate the next outcome with the previous streak. A key part of achieving emotional detachment is recognizing that the discomfort you feel after losses is temporary and self-generated. It does not come from the market, it comes from your interpretation of the market. When you experience frustration or fear, it is often because you are placing demands on the market that it cannot fulfill. You may want it to validate your analysis, confirm your skill, or compensate you for previous losses. Detachment means releasing these expectations. You approach the market without demanding that it behave a certain way. You observe, you respond, but you do not impose your emotional needs onto the outcome. This neutral mindset restores clarity and prevents impulsive reactions. Another layer of emotional detachment involves letting go of the illusion of control. Many traders believe that if they study more, try harder, or force themselves to be more disciplined, they can eliminate losses. This belief is a trap. Losses are built into the structure of trading. They cannot be avoided, only managed. The desire to avoid losses creates fear, and fear destroys detachment. When you accept completely that losses will always be part of the experience, you stop resisting them emotionally. Acceptance is not resignation, it is alignment with reality. This alignment creates mental calmness, and calmness allows you to follow your process without interference. To detach emotionally, you must also clarify your internal definitions. If you see a loss as something negative, punishing, or embarrassing, detachment is impossible. But if you see a loss as a cost of doing business, as a necessary component of a probabilistic outcome, then your emotional response changes dramatically. A trader who believes losses are dangerous panics. A trader who believes losses are normal stays composed. Detachment grows from that belief structure. Most traders attempt to detach through sheer willpower, but detachment is not about forcing yourself to feel calm. It is about removing beliefs that activate emotional responses in the first place. When you understand the true nature of trading, that outcomes are random, that your edge plays out over a series of trades, that a single trade is meaningless, you create a psychological environment where emotional reactions have no space to thrive. The mind becomes quiet, steady, and grounded. Emotional detachment allows you to return to the charts without baggage. You see opportunities clearly instead of through the fog of your recent experiences. You become able to act based on what the market is showing you now, not what your memory is reminding you of. This is the state where consistency becomes possible. because consistency requires a stable internal environment. Losses may shake your confidence temporarily, but emotional detachment ensures they cannot destabilize your entire mindset. Reconnecting with your trading process after a period of emotional turbulence is one of the most stabilizing actions a trader can take, yet it is often the last thing traders do when they're shaken by losses. When the mind becomes clouded by frustration, fear, or the urge to make everything right immediately, the process that once grounded you begins to feel distant. The structure that once gave clarity starts to look rigid or limiting, and the temptation to deviate grows stronger. This is precisely where the spiral begins. The more you drift away from your process, the more random your decisions become. The more random your decisions, the more unpredictable your results. And the further your results drift from consistency, the more pressure you feel. Reconnecting with your process is about breaking this cycle and returning to the psychological framework that supports rational, probabilistic thinking. A trading process exists to protect you from the emotional distortions that markets naturally provoke. Without it, you're left exposed to impulses, fears, and expectations. The process acts as a filter that keeps your actions aligned with your edge, even when your emotions are urging you to do something else. When you lose this connection, you aren't just deviating from rules, you are disconnecting from the mindset required to trade effectively. Every process has components that are designed to create structure, identifying setups, defining entry triggers, calculating risk, determining stop placement, managing open positions, and reviewing results. These steps are not random, they create an internal environment where clarity is possible. When you reconnect with them after a turbulent period, you are restoring the mental order that allows you to think objectively. The reason traders struggle after losses is not because the process stops working, but because their emotional state interferes with their ability to follow it. A process that was perfectly functional days earlier suddenly feels restrictive. You begin questioning whether your rules are too strict or too loose. You start imagining that if you just modify one or two steps, you might avoid more losses. But the moment you begin editing your system out of emotional discomfort, you are no longer engaging with the market logically, you are reacting. Reconnecting with your process means returning to it without emotional modification. You approach it the same way you designed it, respecting its integrity and structure. One of the first steps in reconnecting with your process is acknowledging that the process itself is the anchor, not the outcome of the last few trades. Losses often trick traders into believing they need to change something immediately. But reacting to short-term fluctuations by altering your system is the fastest way to destroy long-term consistency. The process represents your edge, the statistical arrangement of patterns, conditions, and behaviors that give you a probabilistic advantage. When you follow the process, you allow the edge to unfold over time. When you abandon it, you rely on randomness. Reconnection is about remembering that your job is to execute your edge, not to eliminate losses. Understanding the psychological role of your process helps you reconnect with it more naturally. A process provides certainty in a domain where outcomes are uncertain. It provides stability in an environment that can shift in seconds. When you engage with your process, you are shifting your attention from what you cannot control, the market, to what you can. This shift is powerful because emotional turbulence often comes from trying to control outcomes. You want the market to prove your analysis right, to compensate for previous losses, or to behave according to your expectations. But the market is indifferent. By focusing on your process, you redirect your energy from expectation to execution. You stop demanding specific outcomes and return your focus to doing what's required moment by moment. Another important aspect of reconnecting with your process is recognizing the difference between a losing streak caused by poor execution and a losing streak caused by natural variance. Traders often blame their system when the real issue is their own behavior. Were you following your rules precisely? Were you taking impulsive trades driven by emotions? Were you managing risk according to your plan? If the answer is no, then the process didn't fail, you simply stepped outside it. If the answer is yes, then the losses may be a normal part of the statistical cycle. This distinction is essential because it prevents unnecessary system changes and helps you restore confidence in your method. Reconnecting with the process means seeing the truth clearly without emotional distortion. Once you identify where the disconnect happened, the next step is to immerse yourself back into the structure. This immersion can be mental, mechanical, or both. Reviewing your trading plan, recalibrating your chart templates, revisiting your rules, and going through past trades where you executed perfectly can create a strong mental reset. These actions reestablish familiarity and comfort with the system. When you revisit your process in detail, you remind yourself of the logic that supports each step. This reduces the emotional noise and helps your mind shift from reaction mode to structured thinking. A powerful way to reconnect with your process is to simplify your approach temporarily. Complexity amplifies emotional stress, while simplicity restores clarity. If your process includes multiple setups or layers, narrow them down for a short period. Focus on one core pattern, one time frame, or one market. This intentional simplification gives your mind room to breathe. It reduces pressure and minimizes the mental load required to execute. Once your confidence stabilizes, you can reintroduce the full scope of your system. Simplicity is a bridge back to consistency. Reconnection also means accepting the discipline that your process demands. A trading plan is only useful when you follow it. Emotional turbulence makes discipline feel restrictive, but discipline is actually liberating. It frees you from indecision, doubt, and impulsive behavior. When you recommit to following your process without compromise, you regain control over your actions. This internal control is what allows you to remain composed, even when external conditions are chaotic. The more faithfully you follow your process, the faster your psychological stability returns. Reconnecting with your process also involves trusting it again. Trust is often the first casualty during difficult trading phases. You may start doubting your setups, your timing, or your ability to read market structure. But trust is built through repeated observation of the process working over time. Reviewing past trades, re-examining your journal, and analyzing the edge statistically can restore that trust. You remind yourself that the method has produced results before and that it is capable of producing results again. Trust gives you the confidence to execute your next trade without hesitation. When you reconnect with your trading process, you are reestablishing the mental environment where consistency grows. You align your thoughts, actions, and expectations with the probabilistic nature of the markets. You regain a sense of internal balance that allows you to act without fear and interpret the market with clarity. The deeper your connection to your process, the less influence emotions have over your decisions, and the more naturally your trading begins to stabilize. Reviewing losses objectively is one of the most transformative skills a trader can develop because it separates emotional interpretation from factual analysis. When losses occur, especially consecutive ones, the natural tendency is to see them through a distorted emotional lens. Anger, fear, embarrassment, and frustration start to color the way you interpret each trade. Instead of looking at what actually happened, the mind begins weaving narratives that reinforce the emotional state you're in. You might start thinking the market is unfair, your edge is broken, or that you're suddenly incapable of making good decisions. But none of these interpretations are rooted in objective truth. They are emotional reactions. To regain stability, you must examine every loss with neutrality, curiosity, and precision. Objective review begins with acknowledging that losses are not inherently meaningful. They only gain meaning when you attach emotion to them. A loss does not tell you that you're a bad trader, that your future trades will fail, or that your system is flawed. A loss is simply a data point within a larger distribution. When you adopt this perspective, you create the mental space needed to analyze your trades accurately. The moment you remove emotion from the equation, the market becomes clearer. Patterns emerge where emotional fog once dominated. The process of reviewing trades stops being self-punishment and becomes an opportunity to deepen your understanding. The first step toward objectivity is separating the loss itself from the way you executed the trade. Many traders conflate the two, assuming that a losing outcome automatically means a bad decision. But the market doesn't work that way. You can execute perfectly and still lose. You can break all your rules and still win. This is why identifying whether the loss resulted from poor execution or natural randomness is essential. When you focus on the quality of the decision rather than the outcome of the trade, you're able to see the truth without bias. This distinction is the foundation of objective review. If a loss came from natural variance, meaning you followed your plan, executed cleanly, and the trade simply didn't work out, there is nothing to fix. This is one of the hardest concepts for traders to internalize. The human mind wants to eliminate all discomfort, but in trading, discomfort is part of the process. Accepting that some losses are unavoidable frees you from unnecessary self-criticism. Objective review allows you to see these losses as neutral events rather than as evidence of failure. This mindset prevents you from altering your system irrationally and keeps you anchored to your process. If, however, the loss came from poor execution, entering too early, holding too long, moving stops, skipping rules, or being influenced by emotions, then the review becomes a learning opportunity. Instead of blaming the market, you turn your attention inward. You begin exploring the underlying reasons for the deviation. Was it fear of missing out? Was it impatience? Was it an attempt to recover previous losses quickly? Objective review helps you identify these psychological triggers without judging yourself. Judgment closes the mind. Observation opens it. By observing your behavior honestly, you start to build self-awareness. And self-awareness is the gateway to consistency. Another element of objective review is understanding context. Traders often evaluate losses in isolation without considering the broader market environment. You might have taken a valid setup, but the conditions were choppy, volatile, or trending too aggressively. By understanding context, you learn how your system interacts with different market states. This awareness helps you refine your approach without abandoning your core strategy. Objective review is not about overhauling your method. It's about aligning it better with its natural strengths. To review a loss objectively, you must also learn to strip away the emotional story you've attached to the trade. Instead of asking, "Why did this happen to me?" shift to what happened in the market and what was my role in it. This shift transforms victim mentality into analytical thinking. Victim mentality creates fear and hesitation. Analytical thinking creates clarity and control. When you analyze losses factually, you reclaim your ability to make rational decisions. Writing your thoughts is another powerful tool in objective review. When you document the details, entry reason, emotional state, market conditions, you externalize your thinking. This allows you to see patterns in your behavior that you miss otherwise. Over time, recurring mistakes become obvious: rushing entries, avoiding stops, chasing candles, fighting trends. When you identify these patterns, you gain leverage over them. Patterns you can see are patterns you can change. Patterns you ignore continue to sabotage your progress silently. Objective review also means resisting the urge to dramatize results. Many traders catastrophize after losses, imagining that one bad day means the end of their trading career. But objective review reminds you that losses are temporary and statistical in nature. The market does not assign meaning to them, you do. By stripping away the drama, you prevent a single loss or a streak of losses from influencing your next trades. This prevents the emotional spillover that often leads to impulsive decisions and deeper drawdowns. A critical part of objective review is recalibrating expectations. Traders often expect their system to perform flawlessly, and when it doesn't, they react emotionally. Objective review forces you to confront the reality that no strategy wins all the time. Your job is not to eliminate losing trades, but to execute well enough so that your edge plays out over a series of trades. When you internalize this truth, losses lose their emotional charge and become merely part of the statistical journey. Reviewing your losses objectively also helps rebuild trust in your process. After a losing streak, confidence is often shaken. You start doubting everything: your setups, your timing, your understanding of the market. But when you analyze each trade without emotion, you begin to see that the system still works. The market hasn't changed dramatically. Your edge hasn't disappeared. The consistency you are looking for is on the other side of clear, unemotional analysis. Trust is rebuilt not by winning trades, but by understanding precisely why losses happened. Objective review gives you the perspective necessary to make small, targeted improvements rather than sweeping, impulsive changes. Instead of reinventing your entire approach, you make subtle refinements based on clear evidence. This preserves the integrity of your system while enhancing your execution. Over time, these small adjustments compound, leading to a higher level of consistency. Ultimately, objective review is a form of psychological detox. It clears out emotional residue from past tests, resets your mental state, and restores clarity. When you can look at your losses without fear, shame, or frustration, you create the internal space needed to return to the market with composure. The market becomes less threatening, decision-making becomes more precise, and your confidence becomes grounded in understanding rather than hope. Reducing position size temporarily after a losing streak is one of the most effective psychological resets a trader can use. Yet it is often misunderstood. Many traders believe that lowering their position size is a sign of weakness, fear, or lack of confidence. In reality, it is a strategic decision that allows your mind to recalibrate and regain clarity. When you shrink risk, you immediately reduce emotional pressure. The market feels less threatening, each tick seems less personal, and your mind becomes less reactive. This shift in emotional intensity has a profound effect on your ability to follow your process. When the stakes feel lower, discipline becomes easier, not because you lack skill at higher risk levels, but because your nervous system is no longer overwhelmed by the emotional residue of previous losses. A losing streak of 10 generates internal tension. The mind becomes preoccupied with recovering losses, proving something to itself, or validating its identity through the outcome of the next trade. This creates a psychological burden that intensifies decision-making pressure. When you are trading large position sizes, or even the same size you were trading before the losses, your mind feels the weight of potential pain. That weight narrows focus, increases hesitation, and destabilizes the ability to see the chart objectively. By temporarily reducing size, you give the mind room to breathe. The future no longer feels like a threat. Instead of thinking, I can't afford another loss, you shift to a calmer perspective where you can assess and execute without emotional interference. Lowering position size also helps break the cycle of revenge trading. After multiple losses, the instinct to get it all back becomes strong. This instinct is dangerous because it shifts your mindset from executing your system to chasing outcomes. When you cut your size, you disrupt that instinct. You can no longer chase aggressively because the reduced size prevents the emotional payoff you're unconsciously seeking. This sees you back into a process-focused mindset. It becomes easier to wait for clean setups, follow your rules, and ignore impulsive urges. The trade becomes about precision again, not emotional compensation. Another benefit of reducing size is that it reestablishes your emotional connection to discipline. Discipline is not something you access when you're calm. It's something you lose when your emotional state becomes overloaded. Smaller risk reduces emotional overload. When risk feels manageable, discipline feels natural. You no longer have to fight yourself to follow your plan. You are no longer battling internal narratives about what you should do. Your mind relaxes because the perceived threat is lower, and relaxed minds follow rules more easily. This is why position size is deeply tied to psychology. It isn't just a risk factor, it's a mental factor. Reducing size also helps rebuild your trust in the system. After losing streaks, doubt creeps in. You question whether your setups still work, whether the market has changed, or whether you still have the ability to trade effectively. When risk is high, these doubts become debilitating. But with smaller size, the pressure to be right diminishes. You can test your edge again with clarity. You can observe how the market responds to your signals without the emotional load of significant financial impact. When you start seeing your system behave normally again, trust naturally returns. You begin to remember that your edge never disappeared. It was your emotional state that distorted your perception. Lowering position size also sharpens your execution. Traders often underestimate how much emotional tension corrupts execution. When you reduce risk, your mind is able to focus on the technical details of the trade rather than the emotional implications of the outcome. Your entries become more precise. Your patience improves. Your stops are placed logically instead of emotionally. You manage the trade according to your plan rather than according to fear. Execution becomes cleaner because the stakes feel lighter. This cleaner execution often leads to better results, which then reinforces confidence. Another key aspect of reducing size is that it helps you reestablish rhythm. Trading is not just about strategy, it's about flow, timing, and psychological balance. After a losing streak, your internal rhythm becomes disrupted. You may find yourself entering too early, exiting too late, or second-guessing every move. Smaller size allows you to regain your rhythm slowly, one trade at a time. You reconnect with the feeling of executing calmly and objectively. You regain the intuitive sense of waiting for your setup to align. Rhythm returns not by forcing yourself to be perfect, but by minimizing emotional pressure so your natural decision-making process can function properly again. Reducing position size is also an act of self-respect. It means acknowledging your current psychological state without judgment. It is an honest recognition that you are temporarily vulnerable to emotional bias. Instead of pretending to be unaffected or trying to appear mentally strong, you accept your human limitations and adapt your behavior accordingly. This acceptance is a powerful psychological foundation. It allows you to grow rather than fight yourself. It prevents the internal conflict that leads traders to blow up accounts while trying to prove they're strong enough to handle the pressure. Reducing size is not a retreat, it is a strategic recalibration. Additionally, smaller size restores objectivity in market interpretation. When risk is high, you see the market through the lens of your fears. You interpret candles and patterns emotionally. You become hypersensitive to fluctuations. But when risk is small, your perception becomes clearer. You see the chart as it is, not as a reflection of your anxiety. Objectivity is not a mental trick. It is a natural result of lowered emotional stakes. Smaller size aligns your mental environment with the analytical nature required for trading. Another reason reduced size works so effectively is that it minimizes the cognitive load associated with trading. Higher stakes amplify the number of internal variables the mind must manage: fear, hope, tension, anticipation, doubt, projection, and self-judgment. Smaller risk reduces these variables. When cognitive load is low, mental clarity is high. You can focus on the mechanics of the trade without being distracted by emotional noise. This clarity helps you regain the psychological momentum that consistency requires. Reducing size is also a crucial step in preventing emotional spillover. After losses, the emotional energy from those trades can contaminate your future decisions. You may unconsciously act out of fear, frustration, or urgency. Reduce your size, and the emotional spillover weakens. You create a psychological barrier that protects the next trade from the baggage of previous ones. This separation is essential for maintaining a probabilistic mindset. It allows each trade to stand on its own as a unique event, unpolluted by emotional memory. Finally, lowering position size helps you transition from emotional decision-making back to logical decision-making. The brain is more capable of rational choices when the perceived threat is low. Smaller risk reduces the threat signal. This neurological shift allows the logical, analytical part of the mind to regain control. You become more patient, more methodical, and more aligned with your trading plan. The need to be right diminishes. Acting in accordance with probabilities becomes natural again. The market stops feeling like an adversary and returns to being an environment where your edge can express itself through consistent execution. Treating each trade as an independent event requires a fundamental shift in how you perceive the market, yourself, and the relationship between past outcomes and future probabilities. Most traders unconsciously carry the emotional residue of previous trades into the next one. If the last trade was a win, they may feel overconfident, relaxed, or even invincible. If the last trade was a loss, they may feel hesitant, fearful, or pressured to compensate. These emotional traces distort perception, influence decision-making, and erode discipline. The mind naturally wants to find patterns, connect events, and create meaning where none exists. But the market does not operate according to your emotional timeline. The chart does not remember your previous trade, your struggles, or your expectations. Each moment is neutral. Each signal stands alone, and each trade carries its own probability independent of what happened before. Understanding true independence begins with accepting that markets operate on randomness within structure. Your trading edge gives you a probabilistic advantage, not a guarantee. When you take a trade, the outcome belongs to the statistical distribution of your system, not to your personal emotional history. If your edge wins 50 out of 100 trades, you have no control over which specific trades fall into the 50 winners or the 50 losers. You cannot influence the sequence of outcomes, only the quality of your execution. When you internalize this, you stop projecting expectations onto individual trades. You stop believing that you are due for a win or that a previous loss increases the chance of a future one. Each trade becomes a separate event with its own characteristics, conditions, and probabilities. Treating trades as independent events also requires detaching from emotional continuity. Emotional continuity is the tendency for feelings from one event to flow into the next. If you suffered a large loss, the emotional pain often follows you. You carry it into the next setup, and your mind interprets the chart through fear. You hesitate, second guess, or skip the trade entirely. This reaction is not based on the chart, it is based on emotional memory. The market did not change, your internal state did. By seeing each trade as independent, you prevent emotional carryover. You allow yourself to approach each setup with a neutral mind. Neutrality is not passiveness, it is clarity. It is the ability to see the chart without projecting the past onto it. Independence also means rejecting narrative thinking. Traders tend to create stories to explain their experiences. I lost 3 trades, so the next one has to work, or I've been winning all day, maybe I should stop before it turns. These narratives are emotionally satisfying but intellectually false. They distort decision-making by replacing objective analysis with emotional logic. The market is not tracking your personal storyline. The only thing that matters is whether the setup in front of you meets your criteria. When you remove narratives, you free yourself from self-imposed pressure. You stop trying to protect your ego and start focusing on executing your edge. Another element of independence is learning to respect the uniqueness of market conditions. Even if 2 charts look similar, the conditions behind them may be completely different. Liquidity may differ, volatility may shift, fundamental catalysts may be present, or the broader structure may have changed. Assuming that the current trade will behave like a previous one just because the pattern looks familiar. A cognitive trap. Independence means analyzing each trade based on the conditions that exist right now, not based on what happened the last time you saw something similar. This sharpens your decision-making and prevents you from forcing trades based on memory rather than analysis. Treating trades independently also reduces psychological burnout. When you string trades together emotionally, you create artificial pressure. You feel as if you are climbing out of a hole after losses, or trying to protect gains after wins. This pressure is mentally exhausting because it makes trading feel like a continuous battle with rising stakes. But when each trade stands alone, the pressure dissolves. You no longer carry the weight of the last trade. You no longer fear losing what you gained earlier. You approach the chart with a fresh mind each time. This reduces emotional fatigue and increases your capacity for consistent execution. Independence also helps eliminate self-sabotage. When traders tie trades together, they often make decisions based on emotional compensation rather than objective criteria. After a loss, they may rush into another trade to recover. After a win, they may take oversee Z risk because they feel ahead. Both behaviors come from linking trades psychologically. When you view each trade as an isolated event, you stop compensating emotionally. You take the trade because it meets your rules, not because you're trying to change your emotional state. Your identity, your confidence, and your self-worth no longer hinge on the result of any single trade. This detachment allows you to trade with far greater stability. Another aspect of independence is understanding that your edge unfolds over a series of trades, not one. Traders often forget that profitability comes from long-term consistency, not individual wins. When you see each trade as independent, you release the unrealistic expectation that one trade must succeed. You accept that losses are part of the distribution. You see the bigger picture rather than obsessing over isolated events. This perspective increases patience and reduces the emotional impact of individual outcomes. It also strengthens discipline because you no longer deviate from your plan in an attempt to avoid or fix losses. Independence also improves your ability to cut losses quickly. When traders attach emotional weight to each TR, they hesitate to exit when the stop is hit. They believe the trade should work because of what happened earlier. They hope the market will reverse to spare them from emotional pain. This hesitation transforms a small controlled loss into a large damaging one. When each trade is independent, you follow your stop without resistance. You exit when your system tells you to because you understand that the next trade is a new opportunity, not a continuation of the past. Finally, treating each trade as independent strengthens your ability to remain present. Presence means engaging fully with the current moment without being influenced by past outcomes or future expectations. Presence is where clarity lives. It is where your mind is sharpest, your analysis is cleanest, and your execution is most precise. When you bring presence to each trade, you operate from a mindset that is aligned with probability, not emotion. You stop projecting, hoping, fearing, or anticipating. You simply evaluate what the market is showing you right now. Presence is the peak psychological state for trading, and independence is what makes that state accessible consistently.